Good evening. Thank you for joining Corporate Connect. I'm Eileen. I'm your host for today. This evening, we welcome CapitaLand China Trust as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Ms. Amelia Tan, Research Analyst from SGX Group, on recent market highlights, followed by the corporate presentation by Mr. Tan Zili, Chief Executive Officer from CapitaLand China, and we will end off with a Q&A session. CapitaLand China Trust is Singapore's largest China-focused REIT with total assets of approximately 5.2 billion as at 30th June 2023. CLCT has a portfolio that constitutes 11 shopping malls, 5 business parks, and 4 logistics parks. The geographically diversified portfolio has a total gross floor area of approximately 2.0 million square meters located across 12 leading Chinese cities. CLCTs invest on a long-term basis in a diversified portfolio of income-producing real estate and real estate-related assets in mainland China, Hong Kong, and Macau that are used primarily for retail, office, and industrial purposes. Without further ado, may I now invite Amelia to give us an overview on how market performs. Over to you, Amelia.
Hi everyone, evening. Thanks for joining us today. Okay, I'll just give everybody sort of like a rundown on the S-REITs market and also some of the highlights. And I think we will all sort of look forward to Mr. Tan's sharing later on. Okay, moving on to the first slide, the next one. All right, this is a slide that I've pulled out from our monthly chart book that the research team actually produces every month. It's a chart book that encapsulates all the key stats of the S-REIT sector. If you want to look at individual REITs, some of the dividend, performance numbers, fund flow numbers, you can find all of that in the every month this chart book that we produce. Now, the S-REITs in general, right, we've got about 42 trusts that's listed on the exchange. Combined market cap of the entire cluster in this sector is about $96 billion. Now, to put it into context, right, at about close to 100 billion in terms of combined market cap, the S-REITs cluster makes up about 12% of Singapore's overall market, in terms of the number of stocks that we have on the exchange, makes up about 12% of the overall combined market cap. But in terms of SDAV, REITs trade about 200 million or so on a daily basis, and that is about 20 to 25% of the daily turnover on the exchange contributed by the S-REIT sector. So quite an important sector and a liquid sector for us over here. Now, our S-REIT sector is grown quite a bit over the last few years. In fact, it has grown at a CAGR of about 7% over the past 10 years. And the FTSE REIT index has maintained a 10-year total return of about 77%. Now, if you look within the index, typically performances across the individual REITs vary, of course, because of the different layers of diversity, right? Now, when I talk about diversity, it could be in a few forms. It could be in what kind of property segments the REITs invest in. It could also be the type of markets that the REITs invest in. Now, if you look at the top right-hand corner, there are 2 pie charts over here, right? It shows that our REITs are very diversified in terms of the markets that they invest in, also in terms of the property segments that they invest in. And in Singapore, across our 40 plus REITs, we've got about 17% of our REITs that invest in property assets outside of Singapore. We've also got 20 of our REITs that invest in both Singapore and also outside of Singapore. And now we have just 3 REITs that mainly invest purely into Singapore. Now, if you look at some of the, where the markets our different REITs are invested in, you can refer to the graph at the bottom right. Over here, you can see, we've got REITs that have properties in China, 11 of them. CLCT is definitely one of them. We've got REITs, 11 of them, they have properties in Japan, 9 REITs with properties in the US, 14 REITs with properties in Australia, so on and so forth. And now I just wanted to just highlight one bit, right, which is over the past few years, we have a lot of our REITs moving into overseas assets. Nonetheless, the Singapore portion, right, the Singapore AUM of our S-REIT sector is still fairly large, and recovery momentum is definitely a key driver for the sector's pickup. If you look at the last quarter, in second quarter 2023, Singapore's real estate sector grew by about 12% year-on-year, following first quarter's expansion of about 7%. Very much, yes, supported by private residential property, but also we've seen some growth in terms of the commercial property space as well as the industrial segments. Now, for local property assets, a key driver for us is the Singapore tourism activity, right? Singapore Tourism Board is, they're expecting tourist receipts, tourist arrivals to increase this year. And I think tourist recovery, something that they've also shared, is also poised to recover fully by 2024, right? If you look at the top right-hand corner, the pie chart, you can see that in terms of diversified REITs now make up the largest sub-segment of the REITs cluster. We've got 9 diversified trusts in this sector. CLCT is definitely one of them. And diversified trusts in our S-REIT sector make up about 40% of the combined S-REIT day-to-day turnover. And all in all, when you look at the geographical mix, you look at the multi-asset portfolio, it definitely helps our REIT managers diversify their risks across industries, across different customers, and also the different currencies. And also just highlighting some of the key stats that we always typically publish on the chart book. The average distribution yield of our REITs is roughly around 7.5% as of end of August. And also the average gearing ratio is around 32%. That's well below the regulatory limit of 50% if the REITs meet the ICR ratio of at least 2.5 times as imposed by the MAS. And on the fund flow perspective, right, just to share a little bit on who is typically buying the S-REIT sector, what we've seen. Since the end of 2021 up till now, the S-REIT sector to date, we've seen over about $2 billion worth of net retail inflows into the sector. Naturally, if you look at REITs, interest rates is always sort of one topic, right? On the rate front, interest rate hikes, we see that it may also peak at some point, right? And despite some of the mid-year uptick in advanced economies, global inflation seems to be trending lower, and also majority expectations that the US Fed funds rate is also perhaps peaking, and that the FOMC would perhaps start cut rates around in second quarter 2024. All right, maybe if we can move on to the next slide, just some highlights from our weekly REIT watch that we publish on the Business Times, just to share some color from some of the sectors within the S-REITs cluster that we're seeing. Now, last Monday, we talked about industrial S-REITs. Why industrial S-REITs? Because this is a sub-segment of the S-REITs cluster that in fact led August's insti inflows, what we've seen, okay? And if we look at some of the top 10 performing S-REITs within the IH S-REIT index, majority of these are also industrial REITs. Now, the top 10 performing S-REITs within the IH S-REIT index actually average around 11% in terms of the total returns. Majority were contributed by industrial REITs. In fact, some of them were what we have over here listed in the table. AIMS APAC REIT, about 11% total returns. MLT, about 9% total returns. MIT, about 7.7%. And the CapitaLand Ascendas REIT, about 7.3% total returns. We also see, aside from these 4 REITs that I've just mentioned, including ESR Logos REIT, these 5 industrial REITs actually drove much of August's net insti fund inflows into the market, totaling at a combined net insti inflow of about $78 million. Now, we saw the July Singapore industrial production numbers for the month of July. It marked the 10th month of contraction, but it's still better than the contraction that the private sector economists had previously expected. And in fact, analysts has also indicated that the better than expected print perhaps also signals a gradual recovery in the manufacturing activity, perhaps gradual recovery coming on the cards in the second half of this year. Now, we took a look a little bit at these 4 industrial REITs, had a look at some of their earnings release, and we noticed that quite a number of our industrial REITs in this space, in fact, in the last earnings results, they reported improved occupancy rates and also noted positive rental reversions for quite a number of their renewed leases. AIMS APAC REIT, for instance, they noted that they're seeing sustained demand for high-quality assets from advanced manufacturing as well as the logistics sector. The occupancy rate grew to over about 98% because much driven by the industrial and warehouse segments. and their renewal leases rental reversion was about 38%, mostly driven from third-party logistics providers. For MLT, Mapletree Logistics Trust, they recorded positive rental reversions of about 4.2%, led by Singapore properties, Japan properties, and also Vietnam properties. For MIT, also recorded positive rental reversions for renewed leases across most of the property segments in Singapore. For MIT, they've most recently announced the acquisition of a newly built data center in Osaka, which they've also said that this will offer them a strategic opportunity for them to diversify into the data center presence in Japan. And the last one, which is CapitaLand Ascendas REIT, right? They've noted that the Singapore logistics segment actually saw close to 40% rental reversions amid a tight supply. And I think this has also sort of outperformed across their overall property portfolio, if you take a look at some of the numbers that they've shared. Now, if we move on to the next slide, this is also a fairly recent study, a report that was published by EY, as well as REITAS, which is the REIT Association of Singapore. They took a look at all our S-REITs and all the sort of climate-related risk disclosures that the S-REITs have disclosed in the past year. And the studies, the paper over here showed that S-REITs have indeed made considerable progress in terms of climate-related disclosures, especially since mandatory climate reporting was first introduced in a phased approach in 2021. So when you look at climate reporting, typically they will look at the TCFD recommendations, right? And the report has noted that for our S-REITs, they were accorded across the S-REITs, right? Accorded a 91% coverage score based on the number of TCFD recommendations that were addressed, and also a 46% quality score based on the level of detail of the disclosure or the depth of the disclosure. And just to share a bit of nugget, which is across the different clusters, diversified S-REITs actually scored one of the highest with 98% coverage score and also a 55% quality score. And the study, the paper also found that S-REITs across global peers actually perform better in terms of the climate risk disclosures. Something to share, which is SGX, we have launched most recently a year ago, the SGX ESG Gnome. It's an ESG data disclosure portal that was launched together by us as well as the MAS. Now, some of the early adopters of the portal, in this case, CapitaLand China Trust, as well as Manulife US REIT, they've sort of, through the portal, they have disclosed some of these ESG data points, and that sort of demonstrates some of the advancements in ESG reporting and also the willingness for the REITs to communicate this with their stakeholders. Both REITs reported close to, I think, 30 of the ESG metrics. In fact, many of them were our SGX core ESG metrics, which include things like greenhouse gas emissions, energy consumption, water usage, employee diversity, anti-corruption measures, which are also very much aligned with the SGX core metrics. Now, if we move on to the next slide, just a bit of a highlight, right? As companies disclose more transparent and consistent ESG data sets, we see a lot more of these newly ESG-related financial products being available to the market, being available to investors. And most recently for SGX, we've last week launched the iShares MSCI Asia ex-Japan Climate Action ETF, which aims to offer investors access to companies that are deemed to be considered better positioned for the transition towards a more low carbon economy. For this ETF in particular, it actually follows the underlying index, which is the MSCI Asia ex-Japan Climate Action Index, which is designed to sort of represent the performance of companies that have been assessed to lead their sector peers in terms of positioning and also some of the actions that the companies are taking towards climate transition. Why am I talking a little bit about this is that within the ETF or within the index itself, across the 600 constituents in the index, 4 of them actually are our S-REITs as well, with a combined weight of just under 1%. And the 4 S-REITs in the index are CapitaLand Ascendas REIT, CICT, CapitaLand Integrated Commercial Trust, MLT, Mapletree Logistics Trust, as well as Mapletree Pan Asia Commercial Trust. Now, aside from talking about this new ETF that SGX has launched, the next 2 slides, if we can move towards that, for investors that are, looking at the REIT sector, but maybe perhaps you might want to invest in a broader index rather than doing individual REITs stock picking. There are actually five REIT-focused ETFs available on the exchange, of which 2 of them are Singapore-focused REIT ETFs, the Lion Phillip S-REIT ETF, as well as the CSOC IH REIT Leaders ETF. The next slide shows 3 other REIT ETFs. This one is more diversified across the different geographical markets, also across the different types of property segments, of course. The Nikko AM Straits Trading Asia ex-Japan REIT ETF is one. This has about 75% exposure to Singapore and the rest across Asia Pacific. The second one is the Phillip SGX APAC Dividend Leaders REIT ETF. This one has a smaller percentage, about 30% Sing, 56% Australia, and the rest from Hong Kong and Thailand exposure. And of course, the last one is more of a green/ESG focused REIT ETF, which is the UOB Asia Pacific Green REIT ETF. This one has exposure, I'm seeing over here on the slide, Singapore exposure is about 25%, with the rest coming from Australia, Japan, as well as Hong Kong. All right, so many options for investors to look at, individual REITs, as well as the ETFs that offer exposure into the sector as well. Now, I'll end off with the last slide. This is the SGX Invest Telegram, the official channel, where we push out much of our research content, and you can find the monthly S-REITs and Property Trust chart book over here on the Telegram too. So do feel free to follow us on Telegram, and we look forward to hearing a little bit more with the sharing from CLCT by Mr. Tan. Thank you.
Thank you, Amelia. We now invite Tan Zuri, Chief Executive Officer for CapitaLand China Trust, to give us a short corporate presentation. Over to you, Zuri.
Thank you. Thank you, Eileen. And thank you, Amelia, for the overview. Good evening, everyone. Welcome to this evening's SIAS Corporate Connect session. Let me give you a quick overview. I think for most of you, some of you could have followed us for a long time ago, and some of you could have just joined recently. So let me just give you a quick overview of the REIT, what we do, so that you have a bit of background and context. I'll share a little bit on our first half 2023's financials and operational metrics and updates before closing to focus on what this REIT will be focusing to do in the coming years before I open it up to some Q&A. First and foremost, I think CapitaLand China Trust, or CLCT in short, I think we are the first and the largest focused China REIT that is sponsored by CapitaLand. We started listing in 2006. We started primarily as a China retail pure play, but since then we have in fact transformed and opened up our investment mandate to widen into other asset classes. So today we are a multi-sector diversified REIT comprising 11 retail malls, 5 business parks, and 4 logistics parks. In terms of geographical footprint, we are spread across 12 high-growth cities in China, primarily oriented towards the Tier 1. I think most of you will be familiar with the Beijing, Shanghai, Guangzhou, and also the more prominent provincial capital cities around the Yangtze River Delta side, for example, Suzhou and Hangzhou, and also the western side like Chengdu and central like Wuhan. Our GFA is well spread and it's about 2 million square meters. In terms of our AUM, today we are about 5.2 in terms of Sing dollars. Our portfolio occupancy are healthy, relative to the market that we operate in. And based on 1/2 our distribution, and based on the August trading price, we are actually distributing a very attractive risk-adjusted yield to unit holders of 8.2%. CLCT as a long-term China play, I think our position is to really align ourselves, in terms of positioning the portfolio to be able to capture the different asset classes that are backed up by China's own economic policies and their own development plan. I think 2 main pillars sort of stand out. I think China's economy is moving towards more domestic consumption. I think on the other key pillar is also to depend on themselves a bit more, self-sufficient, self-contained, and also trying to push on the innovation and technology curve. So I think these are the two main themes that we are thinking to position our asset classes to be able to ride China's future economic growth. So from 2019, we have pivoted from a pure retail play and added business parks and logistics parks. I think if you look at logistics parks, in terms of the e-commerce, the last mile delivery, I think this will help us really widen, to be able to tap the consumption flows. On the business park side of things, you look at the tenants. I think these are the sector tenants that the local government will be supporting. For example, on the semiconductors, the electronics, the biomedical. So these are the homegrown, local champions that they would like to incubate, and these are the typical users of our business parks. And this have been our main focus since the mandate was expanded in 2020, and roll forward to 2022 and 2023. Besides, looking at new acquisitions, we are constantly reviewing. What we have been also focusing on is to really extract value from our existing assets. I think there are a couple of assets that I'll share a little bit more on how we have conducted asset enhancement initiatives. And these actions have now been able to help us, inject, I would say, more updated and more higher yielding offerings that will help us to be able to capture some of these consumer spending and return of traffic, as China lives itself, beyond the COVID chapter. And we do so, if you look at how we reconstitute our portfolio, at the same time, we have actively managed by divesting, unlocking value for some of the more mature assets. So we have divested 5, and part of the proceeds have been recycled to help us to fund the growth new pillars that I mentioned. And we do that by looking internally at our sponsors pipeline and also third-party acquisition. So we have a strong operating team on the ground that help us look at opportunities as such. This is a quick snapshot over the years since our IPO. I think if you largely look at in 3 phases, I think in the first few years, I think we have been really been concentrating on our IPO portfolio of assets and operating them well. And at the same time, we have also added 1 key assets in Beijing. So that essentially was how we have grown ourselves organically with 1 acquisition in the first, I would say, 3 to 5 years of our listing period. And the acquisition value is about 300 million Sing dollars. You roll on to the second 5 to 6 years, I think what we have been concentrating is to selectively move into new cities, new assets. So we made an acquisition in Wuhan, being a sponsored pipeline. At the same time, the REIT has also ventured into third-party acquisitions, adding Grand Canyon in Beijing and also Xingnan in Chengdu. So growing our retail presence across 7 cities. And if you look at the second phase of our growth, we are doing acquisition value close to about double the size of our first chapter. It's actually the last 5 to 6 years, I would say that, the portfolio has gone through not just organic and going through acquisition, but more so of that reconstitution and that transformative growth that I was introducing a bit earlier. So you see us actively recycling, opening our mandate expansion and rejuvenate our portfolio. So we've added in the newer economy assets, and today we are 20 assets in the presence of 12 cities. And if you look at the volume of acquisition and divestment, we are almost like 4 times what we have done in the previous 5 years. So I think this is a demonstration of the active approach that we are managing the portfolio and business in China. While we grow our portfolio, I think 2 areas stand out. I think not just wanting to grow, we are also having a very disciplined approach, in ensuring that the net property income is growing well, at the same time flowing down to the distributable income that we pay out to the unit holders. And where things are today, if you look at CLCT distributing at about 8.2%, this is a healthy yield spread. I think if you look at the relative to the Singapore 10-year government bond yield or the China 10-year government bond yield, I think we are at 5% yield spread. I think in the context of our history, I think besides the global financial crisis around the 2008, 2009, this is probably an area that era that you can get that risk-adjusted return looking at this counter. Also, if you look at our trading volume over the years, I think it has also reached a more healthy level of more than 3 million on the average trading volume per day. I'll now move on to touch a little bit on our financials. I mean, for our first half, if you look at where we have landed, I think in terms of total portfolio revenue, we have grown about close to 1% in renminbi terms. But because of the renminbi exchange, when you translate back to Sing dollars is very, very strong in the first half of 2023. So that resulted in a translation weakness. And all in our distribution, if you look at it, coupled with that translation and also the high interest cost, we are distributing 3.74 cents, largely in terms of the operating performance, although we are okay in terms of that holding that level, but it's eroded somewhat by the interest rate rise and also the currency exchange. Trying to understand our operating portfolio, I think what we have done in the first half is also to actively, I mentioned AEI some of the assets. So some of these AEI assets are actually having a little bit of downtime. So that actually will also impede a little bit of the stabilized income. Some of these assets in terms of the AEI will only be contributing in the third quarter and also the fourth quarter. So we expect, as things improve, as our AEI completes, our income will also grow. Some of the key takeaways, I would say, if you look at our efforts of AEI, I would say that, our active leasing have helped us, to move the occupancy sequentially over the last 2 quarters. So that has been improving. Interestingly, if you look at where things are in the first half, I think sales and traffic have also improved relative to where we are a year ago. And these are actually led by some of the dominant malls, and especially for sales, these are led by some of the AEI efforts that we mentioned. So we continue to look forward, to more upside as some of these AEIs will complete. On the newer economy side, I think the business park started the year on a lower footing in terms of occupancy. I think if you followed us last year during the end of the year, it wasn't a good period of doing a lot of business planning because of the COVID situation. So some of these have lagged in terms of the leasing decisions. So I think we are seeing a little bit of the lag effect. Hopefully this can be caught up, in the second half of this year. But the good thing is, if you look at the rental reversions, I think across our portfolio, I think we are able to clock positive rental reversion, both for the retail and also for the new economy asset classes. I think I mentioned a little bit on how we are capturing the value. I think examples are over at Grand Canyon. We actually took back space from our supermarket. I think this supermarket has been around for a long time, big formats. I think these are no longer competitive. So we are now rejuvenating the whole basement area by leasing out to a smaller supermarket, at the same time releasing more area for us to inject a little bit more interesting offering, widen it, and also to be able to extract higher rental productivity for the NLA. Same thing at the Rock Square. We are doing quite similar things to the basement and also on the level 3. On the capital management side of things, I think we are not immune to the interest rate higher cycle on the Sing dollar front. So we are continuously looking at opportunities to sort of rebalance a bit of our onshore and offshore mix in terms of capturing the easing interest rate cycle that we are seeing onshore to help us lower down the overall cost of debt or to mitigate the rise. And if you look at where we are in terms of 2023, we have completed all our financing for that debt tower coming into 2023. At the same time, we are also very advanced in terms of completing our 2024 tower. At the same time, extending our maturity, pushing in a little bit of the SASTI-linked green loans, upping the percentage, and our ICR at healthy at above 3.4 times. And our consistent policy of hedging our fixed debt portfolio at above 70% help us to mitigate. And I think during this period of time, we continue to see good support from the banking community, and we don't see any issues in terms of refinancing. On the asset front, I think sustainability continues to be what we are focusing on. We have a 2030 kind of a target, and I think the current progress is well in place. I think riding on last year's 2 assets that we have that gold certified, this half year, we have added another 4. Essentially now our biggest retail malls and a good representation of our new economy assets have also been LEED certified. Moving on quickly to where things are in terms of debt capital market. I think the one I want to highlight is that, in terms of gearing, we are maintaining at a healthy level of about 40.2%, maintaining our cost of debt, at an attractive level. I mentioned earlier on all the credit metrics. These are something that management watch very carefully. I also mentioned earlier that we maintain that fixed and floating. So this consistent approach helped us to mitigate, that staggering effect. And if you look at how we have been thinking about our loan books, I think historically, the offshore loans are advantage in terms of the interest rate, but increasing going forward, we do see more opportunities for us to rebalance a little bit on the onshore debt mix because we see interest rate favorable. So as a case in point, I think we have been able to refinance, some of our onshore loans and achieving quite attractive, cost savings. And these have been in place in the first half, and you will see some of these cost benefits flowing through in the second half. So given our fixed float kind of management, we mitigate, the change in the variable interest rate to the DPU impact to a controllable manner. This is another picture for us to appreciate how we have been consistently managing our debt maturity profile. If you look at it, largely we manage it such that no more than 20% of our loan books in terms of debt tower will be up for refinancing in any given year. So even though interest rate could be rising, we help to stagger that effect and ensuring that our DPU will not be impacted in a very volatile manner. Moving on to the portfolio, I think largely if you look at our assets in the respective classes, I would say that we are trending very healthily relative to the market occupancy and vacancies that we are seeing at healthy at above 90%. And this is a chart that I would like to share a little bit more. If you look at the tenancy profile today, I would say that because of our sector diversified, we are much more in a better shape relative to where we started in the first instance. If you look at our tenant streams today, we are well diversified with F&B, coming out at over 20%. And if you look at retail formats, I think fashion, we have increasingly also been diversifying and lowering it such that now we are only about 12 to 13% exposed to this segment. This is part of that active approach I mentioned that a couple of years ago, we actually remove some of these dated formats, like department store, and also going through that process of cleaning up some of these brands that have not really opened up well, and also in terms of being able to keep on improving and improvise their own brand equity over time, that they lose that kind of market share. So we are constantly reviewing the kind of tenant remix such that our mall continues to be very fresh. Overall, if you look at the whole pie chart, our retail mall are very centric towards the middle income, family disposable income, serving them in terms of the essentials. So we have supermarket, we have F&Bs, we have services. So these are the essentials that we are seeing showing good demand. At the same time, we are also expanding, the kind of trade categories and concepts that resonate with today's family spending. So increasingly, you see leisure and entertainment, you see healthy athleisure in terms of sporting and apparel, you see education, you see electronics, IT spending. And interestingly, if you look at the last one over here, I think in terms of jewelry, this is also capturing a lot of the consumer spend. So we focus a lot on tenant remix. We look at the trade categories. We look at who within the trade categories are doing well, taking early actions, in terms of repositioning some of these trade mix. So that has helped our retail mall to continuously refresh and serve our catchment well. Over at the newer economy side, I think I mentioned earlier that if you look at who are the tenants that are growing in demand, we see a lot of electronics, engineering, the infocom, the biomedical. So these are areas that we continuously focus our leasing efforts together with the local government to base some of these brands and this kind of tenant sectors that they want to be located within the district. So this is something that we work closely with the government to position our business parks. On the logistics side of things, I think we are providing the last mile service delivery to the end consumer market, and we have to watch this space carefully in terms of where the leasing demand and also the consumer needs would be. I earlier touched on this. I think the good thing is that if you look at one half year on year, I think in terms of that metric, we are 30% improvement. And then good news is that if you look at where things are moving into July and also moving into August, you continue to see that July month versus a year ago, as well as the August month versus a year ago, trending well. And also some of the stronger malls, you can already see them actually exceeding, the 2019, which is the pre-COVID kind of level. And large part of it was, I mentioned earlier, because of the active AI efforts that we have already conducted and completed. So you see the leading malls of Xizimen, Wangjing, Rock Square, some of these are really propelling some of these tenant sales. These are some examples that we just want to share with you in terms of our one half, in terms of the leasing activities. We continue to see leasing activities improving in the second quarter relative to the first quarter. And we also took opportunity to refresh, some of these F&Bs are doing well. Aside F&B, you can also see us, leasing momentum in terms of the work done, across the trade categories. Quite similarly, over at the business parks, again, you see that improvement in the leasing activities in the second quarter relative to the first. You see more people are looking at, office expansion or rebasing where their footprint is. So there's a lot of conversations around that. And we do see demand coming in from the various sectors, backed by electronics and engineering, the main one. Overall, our portfolio able to churn a positive rental reversion. So as we look ahead, I think what our main focus, again, will be centered around our strategies of creating, unlock, and also to extract. I think I mentioned a few illustrations much earlier on how we have been creating, through diversification, by building new revenue streams, by building new asset classes, and moving into new cities, geographies. And we do so also by having a disciplined approach to look at our existing portfolio, especially for those assets that have been with us, they have been mature. And if you look forward, they are having a lower growth path. I think it makes sense for us to unlock value and monetize them at the right cycle and replow these proceeds, to help us bring on the new asset classes, the new income streams that I mentioned. So this portfolio reconstitution is a mainstay of what we are going to do, and we'll continue to stay the course to do that. On the same time, I think if you look at the assets that we're holding, we are taking a very active, asset management approach by early reviewing some of these leases, some of these big spaces that are no longer productive. So I think we have all these programs to AEI, and we do so by staggering asset by asset. If you look at the COVID period, we had done AEI to Xizimen, then later we move on to Wangjing, and later on move on to Changsha. And when Wangjing and Changsha complete and the AEI area is up and running, we now move on to Rock Square, and we now move on to Grand Canyon. So I think this is some of the staggering AEIs that we will actively continue to pursue, such that our mall continue to be giving that refreshed look to the consumers. Another key area that I would like to share a little bit more is that domestically, if you look at where China's own capital markets are going, I think interestingly, during first quarter of this 2023, they have opened up the asset classes, that could be pilot for the C-REIT. So I think we are watching this space very closely, because if we can participate, and this creates an avenue for us to recycle and also help us longer term, being able to tap on the local capital markets and local liquidity. So I think all in, this is going to create a new catalyst to help CLCT, move towards our journey towards a sector diversified portfolio, which is to be a bit more balanced rather than a pure retail. I mentioned earlier, some of these works are in progress, and most of them, as we speak, have already started to contribute income. This is Grand Canyon, The level 1 has been completed. They had started contributing income from July, August. So you do see them coming into in the third quarter, and the basement will be coming in towards the end of fourth quarter. And at Rock Square, similarly, most of the works have been completed, both for the basement and also for the level 3. So this will start to contribute income from the quarter onwards. Lastly, let me just end off by saying, if you look at the business outlook, I think if you look at where China is, I think a lot of emphasis have been focusing on how the economy is shaping up. I think they have guided towards a 5% GDP growth for this year. At the same time, we also have been watching very closely on the China government's, the policy stimulus. I think you have read a lot in terms of the fiscal and the monetary policy. They have been promoting easing accommodative to support some of this business. And in August, just last month, you can see a bit more targeted policy coming through in terms of the implementation towards the real estate to stabilize the sector, and also to create a little bit more confidence for people to plan their business forward. So some of these policies will take time to filter down, but I think all this is meant to help stabilize, bring back a little bit of that confidence and improve the sentiment. So we're watching out for all this, as we approach the later half of this year. What we can control, I think I've shared earlier in terms of our retail positioning. This is something that will continue to take a very active approach, such that when the confidence comes back, we are able to capture the spending. At the business park side of things, again, we will be actively looking at where our tenant sectors, that focus will be in terms of bringing our tenants to improve the quality of that income resilience in sectors that are being promoted and supported. And over at the logistics side of things, I think, again, we have only a very, very small portfolio. We'll be looking at how we can lease it out in terms of that lease renewal cycle coming in towards the end of this year. I think there's a little bit of that market supply, demand kind of things that we have to go through. I think this is a cycle that we have to ride through, and I hope to be able to bring a little bit more sharing with you when we are in that right frame of time to share the lease renewals. So I think with that, I will end my presentation and hand over to Eileen.
Thanks, Ziwei. I think let me recall that, for the Citizen and Huang Jing was one of the earlier seeds assets, and in fact still staying strong, contributing to the bottom line of the REIT, and with all the AEIs and diversification. Yeah, well done. I think now I will move on to the Q&A session. I will introduce our moderator for tonight, Mr. Gerald Wong. He's also the CEO of this route, and he's also doing the investor educations for SIAS. So over to you guys.
Okay, thanks so much, Eileen, and thanks so much for the sharing earlier, Mr. Tan. We actually have a lot of questions coming in live, but we also had a lot of questions that were pre-submitted. So I will start with a question that has been frequently asked, which is around China. I think for a lot of us reading the newspapers on a day-to-day basis,
I found this on the web.
We see a lot of questions around what is the prospect of the Chinese market and how has that actually affected CLCT's performance?
Yeah, I think if you follow all the Western news, I think chances are you read a little bit of that headlines a bit more. I will encourage most of our investors out there to also have that balanced view, and also trying to read a little bit of news flows that's also emanating from the other side of things, so that you can have a balanced perspective of things. On your question on how things have been on the ground, I think I've shared earlier, I think between 2020 and 2022 was quite a roller coaster ride in terms of the business operating environment. I think we all know 2020 being the COVID, and rebound came back quickly in 2021. But very sporadic, many cities, are impacted again in 2022. That resulted in the abolishment of the zero COVID policy. And that's where we are, heading into 2023. So in the context of that volatility, business had been, I would say, in a very difficult operating environment to be able to plan and execute. So I think what we have seen moving into 2023 is that things start to stabilize. Year to date, things have started to normalize. I think I've shared in our one half, you do see that 30% improvement in terms of traffic and sales. And for those of our malls that have already gone through very active repositioning, bringing on board, new brands, new concepts, you do see them leading, some of these sales recovery and sales rebound. I also mentioned, if you look at where the consumers are spending, I think this is something that is going to be continuously, we need to refine and capture. And you do see us, moving our tenant remix and trade categories to be able to resonate better with that return of that consumer spending. So I think I would say all in our portfolio, they are recovering, but they are not on very even and linear. Certain assets that have gone through the AI are now in a much better shape. We have to take that step approach, to ensure some of our dominant malls are strengthened, enhanced, the tenant quality and income streams as we take certain actions on the rest of our portfolio. So the diversification of our approach have really helped. I think if you look at the market cycles over the last few years, so the new economy have helped us to come in to really stabilize, some of this profile of our earnings. And if you look at our top 10 tenants today, 5 out of our top 10 tenants are drawn, from the newer economy space. So that gives us a good balance. At the same time, we are also, continuously enhancing the strength of our retail mix within our own portfolio. So I think this is the kind of approach that we will take to prepare ourselves within the area that we can manage and control as we ride out, the China market. Hopefully the return of confidence, the sentiments will improve. And when that improves, we are in the queue to be able to capture this.
Okay, thanks so much for that. And I think looking at the live questions, a lot of them still continue to stream in. Raymond here has a question around the occupancy rate at Chengdu, which has fallen to 60% from 90% last year. Can you maybe share a bit about what is happening there?
Oh, you must be referring to one of our logistics in Chengdu. So I think indeed, if you look at our lease expiry around that reporting period cutoff, there are certain tenants that are relooking on where they want to base their business around. We are located in the Shuangliu district, so there are a couple of information coming through, and I think some of these tenants have taken the decision to want to move away from Shuangliu. So I think this could have impacted that decision point. So we are still in the process to backfill some of this vacancy.
Is there any other action that you are undertaking to be able to improve the occupancy?
Well, I think the main challenge, I think right now is really to look at the demand, where is it coming from? This asset we have acquired towards the end of 2021. So we are going through that first leasing renewal cycle. Some of these tenants have decided to move away from the Shuangliu area for their own footprint and their business model. So to replace that, I think we have to more actively reach out to see where else tenant demand will be coming from. This is the only asset where I think we have multiple of leases taking smaller spaces. So part of that whole leasing strategy that we are thinking through is also, does it make sense for us to potentially collapse some of this area into a bigger space and being able to lease out to someone who needs that space over a longer duration? So I think we are going through and deliberating some of these choices, and I think we hope to be able to lease it out as soon as we can.
Okay, so we also have quite a number of participants very on top of the news. This question from Danny around the recent floodings. Any of CLCT properties affected, and what is the extent of damages?
Oh, you must be referring also to a couple of months back where, some of these floods. I think fortunately, CLCT's assets, we are not exposed to those flood risks. So I mean, you look at where our assets are located, they are quite prime in the sense that they are quite in the core city centers. So the recent flood, I think it started on around the northern area. So I think we are not in those districts.
Okay, one question that is more structural in nature, has there been any significant impact from work from home on the demand for business park space?
I think this is a very interesting point. I mean, if you look at where we see the habits of working in Singapore or in the more developed markets, the work from home habits have more or less settled over the last few years. But in China, we don't see that. I think a couple of reasons, observations. I think first of all, our business parks are primarily serving some of the space needs of people who need that space for their R&D purposes, meaning that it's harder for these people to be able to work from home because they need to be in that space to do certain activities. The second, I think if you look at the Asian or the Chinese culture, I think more expectations is such that they come back to office to work. So I think the work from home habits and syndrome has not really played out in the same manner. Part of the reason could be that, if you look at where China is today and most of the people who are working in those areas, they may not have the luxury of having a home that can be very conducive for them to work remotely. So I think a couple of all these factors have helped us in the sense that even during COVID period, that work from home and going back to office syndrome is very quick. Once COVID is lifted, no more quarantine, people move back to their office premises. We don't see that issue happening in our portfolio. Yeah.
Okay, so we have touched on the demand side. There's this question from Han on the supply side. Can you give us a sense of the competition in China with regards to the various segments that you operate in, and what are some of the ways that you are able to stand out amongst this competition?
Yes, I think if you look at our portfolio today, I mean, if you go through the different segments of our asset class, I would say because our early mover advantage into retail in the cities that we operate, if you look at Beijing today, I think the supply situation is, I would say, much controlled because we are in the core nodes of around the second ring, third ring, and fourth ring. So in these core city centers, there are no longer new supply of retail malls. So the government planning is such that they push out new supply into the wider district and being able to create new catchment around the wider district such that they don't over-concentrate the city core. So I think for our retail, I think we are fine in terms of managing that supply situation because of our early mover advantage and we're very core. And we are on top of transport node, and we are serving very captive residential and office catchment. So I think on that front, I think we are steady in the sense that we don't see a lot of new supply disrupting where we operate. For the newer economy, I would say because of where things are, especially in the last few years, we do see a little bit of the supply challenge in certain cities. I would say among our footprint, Hangzhou comes to mind. I think Hangzhou has been a city that is very much driven by the e-commerce online activities in the last few years. So there's the exponential growth in demand. And therefore, there is a lot of supply trying to catch that exponential demand. But a few things come together. I think if you look back, the technology platform, the policy restraints on some of them, the players, the COVID situation have disrupted. Some of these business models are being reviewed. So the demand side start to see a little bit of that lowering. But at the same time, some of this supply that was pushed out to support this demand are now entering the market. So we do see a little bit of the supply situation happening across Hangzhou in particular, in where we operate. If you look at our logistics assets, I would also say that among the various cities, you potentially see a little bit more supply challenge coming through in the tier 2 cities, because of that demand-led thing that people push out supply, and as the demand start to soften, the supply come on stream. So you do see a little bit of competition. So I would largely say that our retail, we don't have a lot of direct supply issue. Business parks, you have to look at the cities in particular. I think Hangzhou stands out a little bit more. Logistics, I think if you look at where things are, so long as you are in the key tier 1 cities, very close to the logistics nodes, I think that's fine.
Okay, so we have talked about the Chinese market. I think the other macro concern that many investors have is on the currency risk. So a number of questions around your hedging of the currency, and how are you better able to mitigate the weakness in the Chinese yuan?
Yeah, so first and foremost, I think we have to accept that we are a China-focused REIT, meaning that all our earnings, all our assets are going to be denominated in renminbi. So I think that's the first point, that for investors in us, we have to somehow be aware and accept that the renminbi risk is going to be there. So how do we mitigate? I think we have a few measures to mitigate. I think first and foremost, I think we try to rebalance a little bit on our asset liability side of things. We are now shifting a little bit more towards the renminbi borrowings, such that we have a natural hedge in terms of our borrowing currency against our asset currency. So that's something that we are continuously looking at opportunities to reset some of these onshore and offshore mix. As a long-term vehicle, because we invest and we own assets over a longer term, I think what's more important to us is in terms of safeguarding the distribution. We distribute income to our unit holders on a semi-annual basis. So I think between hedging the so-called the equity, the balance sheet side of the things, we are more focused to hedge on the income side of things, because we got to repatriate, we've got to pay distributions every half year. So our policy is very clear. We are always maintaining at least 50% hedge on the semi-annual distribution. So that policy has been in place, and we consistently apply that. Of course, beyond that, we are also exploring a little bit more. I think we are actively engaging some of these banks to explore what are the new ideas, or some of these hedging ideas, the instruments that are available. Potentially, we can tap some of these free trade zone bonds that are denominated in RMB, and being able to use that to pay down the same currency. So I think these are some of the measures that we can help to mitigate some of this currency. For investment and for divestment, once we have entered into that so-called agreements, and we know when are we supposed to pay, when are we supposed to receive the proceeds, we also actively manage that part of it, such that we can lock in some of this currency exposure. So I think these are the few nuggets on how we are managing the business over what is more important to us in income. In terms of investment on the balance sheet side of things, we do natural hedging. We consider new hedging instruments, and where investment and divestment are concerned, as a reconstitute, we hedge it when we can lock in the cash flows. Yeah.
Okay, so apart from the FX risk, I think the other area that a lot of investors are concerned about is interest rate risk. Last week, we just saw the Fed mentioning that the interest rates may remain higher for longer. So quite a number of questions relating to interest rate. Just continuing on the onshore versus offshore discussion, is there any reason why you have a significant amount of SGD debt where most of your assets are in China?
Yes, I think this is a very, very valid and good question as we review our current onshore and offshore debt mix. I mean, to bring everybody back to a little bit of context, I think when we started off having this vehicle, onshore borrowing rate was closer to 6%, 7%. And offshore borrowing rates are about 3%, it's about half. So it was during that period of time that it makes sense for us, in terms of that overall cost of debt balancing, it's more optimal for us to borrow in sync on this space. But today, as you rightly pointed out, as the interest rate cycles start to converge, which is exactly what I mentioned earlier, now we are actively looking at opportunities for us to rebase some of these debt books onshore where we can, to take advantage, of the easing cycle. In fact, we have already done a few refinancing onshore this year that we are able to capture, the China's the prime lending rates coming down. And it's also built up to the point that, as the banks become a little bit more circumspect on who they lend to, our kind of business is very distinct from the property developer risk that we are seeing. So we are a REIT. We are very transparent in terms of our earnings and cash flows. Each property, is very transparent in terms of occupancy. So there is some kind of that flight to quality that as you look at banks' own lending books, they will prefer to lend to us. And as a result, we are able to capture some of these interest rate savings. So I think this is something, again, not just on us, and also fortunately, we have a strong sponsor backing that people will continue to look towards. So I think we are doing what we can to enjoy and take advantage of that onshore's lowering of interest as we rebase some of this borrowing. Another point to share is today, because of the China's own control cross-border, we cannot just borrow and gear up onshore and repatriate the money out freely to pay down Sing. So this is something that is to be mindful of. So what we can do is that we have to continuously rejuvenate our portfolio through acquisitions and through divestment. It's only when you churn and reconstitute the portfolio, you can release some cash that are stuck in China. You can repatriate the cash to pay down the Sing loan. And as you build new acquisition, you can restructure the capital structure so that you borrow more onshore, such that you reset, our total book. So I think these are some of the angles and approaches that we are taking to improve that mix.
Okay, so I'm mindful of time because it's now 8 p.m. We still have 19 unanswered questions. We'll move on to this discussion about asset valuation. So how do you see the revaluation of assets? And is there a risk that we could see a downward revaluation of your property assets?
I think so far, if you have the conversations with the valuers onshore, I would say largely the valuers cap rates have been quite stable and constant. This is also reflected in our valuation year on year. Obviously, for those assets that are weaker in the sense that our occupancy takes longer to recover, or some of the signing rents are below the market, you have already seen some of these valuation downside being worked into our portfolio. So some of the weaker assets that took valuation down, includes Grand Canyon, Xingnan, Idamandu last year. But it's balanced up with a little bit of that stronger AEI assets, that's sort of like counterbalance. So we don't see big movement in valuation risk for our retail portfolio. At the same time, you look at the newer economy assets, because of the C-REIT, it has created a little bit of that investment interest in these asset classes because people can move to the C-REIT. And the C-REIT gives you that valuation benchmark. So far, we do see valuation compress instead of expand. I think this is also another key thing to take note. Typically, cap rate expand, when interest rate go up. So I think China's is actually on the reverse cycle. So I don't see a lot of macro or a lot of market-driven cap rate expansion, but more so asset-specific considerations.
Okay, and a number of questions relating to acquisition pipeline and your plans there. Can you share maybe what are your considerations when making potential acquisitions, both from third party as well as from your sponsor?
I think first and foremost, whether is it from sponsor or from third party, I think it has to sit in line with the kind of strategy that we have articulated. I think we wanted to build a sector diversified portfolio, so we wanted to reconstitute. So I think what makes sense for us is to really being able to unlock and monetize some of our existing assets and replow, the proceeds as we pursue growth. At the real estate side of things, I think near term, we would like to move more towards the newer economy and business parks in particular, so that we can strengthen, our portfolio synergies. So this is something that we are working on. In terms of considerations, I think we always look at acquisitions with the accretive in mind. So how do we bring the accretive nature? I think I mentioned it's best that we build that optimal funding mix. So I think we can recycle some proceeds. We still have some debt headroom, and also looking at opportunistic timing of the market when it opens up, to be able to tap some of the equity related as well. So I think if you look at our last few acquisition, how we have been funding it, I think this is going to be our main consideration, always building the optimal blend of debt, equity, and also a little bit of the recycling proceeds to help us grow. Accretion, I think in terms of the portfolio quality, definitely the new asset must help to bring in the synergies, both in terms of the tenant quality and also the cost synergies to continue running the business.
Okay, I think we have pretty much answered most of the questions. Do you have any final comments or key takeaways that we should have from today's session?
I think China continues, I would say, to be a very interesting market. I mean, it is big. Addressable market is huge. So I think for investors who would like to participate in the China's economy, I think we are a proxy to that. I think we have moved from a pure play to now a multi-sector. I think all this is meant to allow us to better capture different real estate asset classes to manage the different market cycles. And if you look at the channel for you to invest into China, I think S-REITs and CapitaLand China Trust being managed by CapitaLand, Temasek owned, the S-REIT regime being very transparent, corporate governance. I think this is something for investors to also, be comfortable in channeling through this channel. And I think CapitaLand, in terms of managing the different asset classes, I think we are in the market for a long time. I think we are 30 years in China. We have strong operating teams on the ground. And I think to play the China game, you really need that domain knowledge, on the ground expertise, for you to be able to be nimble, for you to be able to see the trends, and also being able to take actions early. So I think for people who would like that China exposure, I think we are giving you that opportunity. And the risk-adjusted returns, I think ultimately we invest in REITs for total returns and also for yield. So looking at where the yield today, and when sentiments improve, and when things start to re-rate and people accept the China risk better, I think that's where the total return will also come. So I think I will leave you with that conclusion. Yeah.
Okay, thank you so much, Mr. Tan.
Thank you.
Thank you, panelists, for the colorful Q&A session. I think CapitaLand has a very strong brand name in terms of retail, and definitely is the first mover. I remember, about 20 over years when I first visited the CapitaLand Mall. I'm sure there's a lot more exciting with a lot of pipelines that is upcoming in China, and definitely one of these days I would love to visit one of the malls in China again. Yes.
Of
Okay.
course, we welcome you to go there, and you will see that over time we have changed a lot to the tenancy mix. Yeah.
Yes. Okay. Well, I think we have running out of time for tonight. I'm sure there's a lot of questions that we still would love to answer. And what I will do is I'll probably connect the IR team together with the questions from the audience. If we're unable to answer all your questions, feel free to contact the IR department or the company or SIAS. We'll be able to help you to channel the questions to the company. So in case if you miss any of the today's sessions, you can rewatch the webinar on SIAS YouTube channel. Corporate Connect is our monthly webinar. Do visit our website to get updates on our upcoming investor education programs and initiatives. You can also take note that the upcoming Corporate Connect, which is next week, featuring Chakra Corporation Limited on the 3rd of October. Without further ado, we just want to thank you and have a nice evening.
Thank you, everyone. Goodbye.
Okay,